Central banks are, well, they're hoarding gold right now at historic rates.
Oh, absolutely historic.
Right. So the long-term foundation for precious metals has quite literally never been stronger. But if you look at the screens this morning, the price of gold is just gasping for air.
It's taken a real beating.
It really is. So why is that happening?
Welcome to today's deep dive, everyone. Before we get into the thick of it, please take a quick second to like the video, subscribe to the channel, and drop a comment down below with your opinion. We really want to hear your take on this one.
Yeah, the comments have been incredibly insightful lately, so definitely keep those coming.
Absolutely. So I'm your host, and joining me today to unpack all of this is senior market analyst Dr. Khalid Al-Nuaimi, and we've got a really fascinating contradiction to look at today.
We really do. It's one of the most interesting setups I've seen in a while.
Right. Because right now, United States Treasury yields are handing investors a virtually risk-free 4.5%. And the U.S. dollar index is just, towering over the market, breaking past the 101 mark.
Which is massive.
Exactly. So by all conventional financial logic, non-yielding assets like gold, they should be in an absolute free fall right now. The pressure is just immense. So why are nearly half the world's central banks quietly backing up the truck to buy more of it?
Yeah, well, it is the defining divergence of the market this quarter. I mean, you have retail sentiment flashing deep red based on the daily charts, while sovereign wealth is essentially ignoring the macroeconomic weather entirely.
They're just accumulating physical metal.
Exactly. They are buying heavy while everyone else is panicking.
And that divergence is exactly what we are unpacking for you today. We're pulling apart a really dense stack of morning market reports from June 23rd.
It's a lot of data to sift through for sure.
It is. So our mission here is to map out the invisible structural forces that are currently dragging both gold and silver prices down. We want to examine how institutional players are exploiting this specific volatility, and ultimately help you navigate this heavy data flow without getting crushed by information overload.
Right. And to understand the institutional play, we first have to look at the actual physical realities on the trading floor this morning.
The immediate technical damage, essentially.
Yeah, exactly. The morning reports show gold is just completely boxed in. It's trapped below this heavy psychological resistance at $4,200 an ounce.
It's been stuck there for a bit now, hasn't it?
Yeah, it's consolidating in a painfully tight band, basically between 4,170 and 4,195.
Okay, let's unpack this. It's like gold is jumping up and constantly hitting its head on a glass ceiling at 4,200.
That is a perfect way to visualize it. Because looking at the order flow, that mark isn't just a casual ceiling.
Right.
Every single time the spot price tries to rally and test that upper boundary, we see these massive algorithmic sell walls step in and aggressively reject it. The buying volume just completely evaporates.
Oh, wow. So it's not even a fair fight at that level.
Not at all. I mean, we are seeing classic distribution behavior. The market makers are defending that 4,200 level fiercely.
So gold is basically desperately trying to establish a higher low, but the momentum simply isn't there to absorb that sell-side liquidity resting just above it.
Exactly. It leaves the asset highly vulnerable to sudden downward spikes. But what's really fascinating here is that the canary in the coal mine might actually be silver.
Yeah, I wanted to bring that up. If gold is supposed to be this ultimate resilient asset, why is silver cracking so fast?
Well, the data shows silver breaking its technical structure far more violently than gold. I mean, it recently plummeted from 66.5 down to $64.7 per ounce.
That's a huge drop.
It is, because silver has that dual identity. It's part monetary hedge, but it's also part industrial commodity.
Right. They use it in electronics, solar panels, all of that.
Exactly. So its elasticity makes it a much faster indicator of broader market distress. Silver's price action right now is flashing a very clear warning signal.
So is a drop below 64.5 going to trigger a total free fall? Because that's the number everyone seems to be watching.
That's the critical threshold, yes. If silver breaks and closes below that 64.5 support structure, we are no longer looking at a localized pullback.
It gets much worse.
Yeah. That break opens up the risk of a systemic algorithmic liquidation cascade across the entire precious metals sector.
But wait, didn't we just see a slight bounce earlier in the week? A lot of retail traders were getting pretty excited about that.
They were, but they wildly misinterpreted it. Retail saw a green candle and assumed, the bottom is in. But the institutional reports explicitly label that movement as just technical breathing room.
So it wasn't real recovery.
No, it was essentially short covering. You had traders locking in profits on their downward bets, which temporarily lifted the price.
Yeah.
It's absolutely not a confirmed new uptrend.
Got it. Because the overwhelming macroeconomic pressure is still firmly intact.
Exactly.
Let's examine the mechanics of that pressure, because really, it all originates with the U.S. Federal Reserve's current hawkish posture, right?
Yeah, the market has finally surrendered to the reality of higher for longer interest rates.
Right, because when you look at the 10-year U.S. Treasury yield climbing up to 4.516%, you realize we are dealing with intense financial gravity.
Financial gravity, I like that. That's the perfect way to describe it. When the risk-free rate sits at 4.5%, the opportunity cost of allocating capital to a zero-yield commodity like gold becomes structurally prohibitive.
Because why take the risks?
Exactly.
Sure.
For most portfolio managers, the institutional mandate shifts. You don't need to take on the volatility risk of gold when you can literally lock in a guaranteed 4.5% yield just holding sovereign debt.
So the capital simply rotates out of the metals market and gets sucked into the bond market.
Yeah, it violently drains the appeal of holding gold.
And compounding that gravitational pull is the broader anticipation of the upcoming U.S. personal consumption expenditures data, the PCE.
Right, the PCE.
The entire speculative side of the commodities market seems to have just hit pause. Everyone is waiting cautiously for this specific PCE print.
Yeah, liquidity has completely dried up.
Wait, so you're telling me this massive, global, multi-trillion-dollar precious metals market is essentially holding its breath, completely paralyzed, waiting for one single American inflation spreadsheet to drop? Are we just totally at the mercy of the PCE this week?
I mean, it sounds crazy when you put it like that, but yes. And the paralysis makes perfect sense when you consider how the Federal Reserve weights its metrics.
How so?
Well, the PCE isn't just a spreadsheet. It is the Fed's absolute favorite inflation gauge. It's the specific lens through which they calculate their interest rate decisions.
So the market isn't just waiting on the number itself.
Right. It's waiting on what the number forces the Fed to do. If the PCE comes in hot, showing that core inflation is still sticky, the market instantly prices in a delay of any potential rate cuts.
Which means the cost of capital stays high, the dollar strengthens even further, and gold takes another massive hit.
Exactly. But on the flip side, if the PCE shows definitive cooling, the market immediately starts front-running the inevitable rate cuts.
And that removes that heavy yield pressure off gold.
Spot on. And that binary outcome is entirely why the market is frozen. Institutional money managers are not going to place massive bets right before the Fed's favorite inflation gauge comes out, especially in a macroeconomic environment this fragile.
They're just going to sit in cash and wait for the data.
Exactly.
But here's where it gets really interesting. The numbers on that PCE report are heavily driven by real-time input costs, specifically energy.
Right. Energy is a huge component.
Which brings us to a major geopolitical wildcard happening right now in Switzerland.
Yes, the diplomatic talks.
Right. The morning reports emphasize that the U.S. and Iran are currently holding negotiations in Switzerland, with Pakistan acting as a mediator. Now, keeping this strictly to the market impact, there is reported progress in this first round of talks.
And we've seen the market's immediate response to that progress. It's been incredibly visible in the energy sector.
Yeah, it successfully cooled down oil prices,
That's
right?
fair.
Brent crude has slid down to around $78.7 per barrel, and WTI is at 74.9.
Exactly. And let's trace the mechanics of that drop directly into the inflation data. Lower crude prices immediately reduce global freight and shipping costs.
Which means cheaper logistics.
Right. And those reduced logistics costs eventually bleed into the margins of consumer goods, which subsequently pulls down the core inflation metrics on that all-important PCE print.
Ah, I see. It's a geopolitical domino effect.
It really is.
It's like a diplomatic conversation in Switzerland knocks over a barrel of crude oil, which bumps into the U.S. Federal Reserve's inflation metrics, which eventually crashes right into the price of silver in your retirement portfolio.
That is a fantastic analogy. It is a direct transmission mechanism from geopolitical diplomacy to domestic inflation metrics. The diplomatic progress is actively cooling the inflation fears that drive the Fed's hawkishness.
But the reports highlight a really critical timeline caveat here. These negotiations are scheduled to drag on for at least 60 days.
And a 60-day window is an absolute eternity in options pricing. That leaves the energy market trapped in a massive holding pattern.
Because the risk remains so high.
Exactly. It creates this massive overhang of risk. The decompression we're seeing in crude right now is based entirely on the assumption of continued diplomatic progress.
But what if it falls apart?
Well, if talks stall on day 30 or collapse completely, the risk premium instantly rushes back into the energy market. Crude spikes, which reignites the inflation narrative.
Which forces the Fed to maintain high rates, keeping gold suppressed.
Exactly. The current relief is highly conditional.
I would also add that $78 a barrel for Brent is still a historically robust price.
Oh, absolutely.
It's not as if energy costs have plummeted to a level where baseline inflation is mathematically eradicated. The fire is still burning. The market has just priced in the fact that someone is standing nearby with a bucket of water.
Yeah, the inflation pressure hasn't truly disappeared. And the fragility of that situation is exactly why institutional capital remains so tense and defensive.
They are measuring the probability of a supply disruption against the certainty of a 4.5% Treasury yield.
Right. Why gamble on oil dropping when you can take a guaranteed yield?
This brings us to a fascinating structural misalignment in the reports. We've established a pretty bleak short-term horizon. Hawkish Fed, a towering U.S. dollar, a 4,200 resistance ceiling, and these 60-day geopolitical energy risks.
It sounds incredibly bleak.
It really does. Yet amidst all of this, Morgan Stanley has issued a massive $5,200 per ounce target for gold in the second half of 2026.
Yeah, their target is very aggressive. But we have to look at the fine print. They attach a crucial mechanical condition to that forecast.
Right. They warn that this is functionally impossible unless massive ETF cash flows return to the market.
Exactly. And looking at the data right now, ETF flows are completely dry. The retail and speculative liquidity pools have evaporated.
So what brings them back?
Morgan Stanley points out that those inflows simply will not return until the market sees a definitively softer Fed and a weaker dollar. Retail investors need the macroeconomic weather to clear before they start buying momentum again.
Which leaves a gaping hole in the demand side of the equation. If the speculative money is out and the ETFs are bleeding outflows, the natural question is, who is actually keeping the market from completely collapsing down to, say, 3,500 today?
Well, if we connect this to the bigger picture, the answer is, in the World Gold Council and Reuters survey included in the June 23rd reports, the real foundational support right now comes from sovereign entities.
Central banks?
Yes, a staggering 93% of the surveyed central banks globally are currently holding gold.
93%. Wow.
Right. But the really actionable metric here is that 45% of them plan to actively increase their physical reserves over the next 12 months.
That is just staggering. Nearly half of the world's central banks are actively ignoring the 4.5% Treasury yields and the strength of the dollar and choosing instead to stockpile a zero-yield asset.
It completely changes how we have to view the current price action. You have retail investors staring at the 5-minute charts, sweating over a break of the 4,170 support band, and panic selling. Meanwhile, the actual central banks of the world are sitting underneath that exact price action, quietly absorbing all that retail panic.
So retail investors are sweating over daily chart drops and panic selling, while the actual central banks of the world are quietly backing up the truck and loading up their vaults. That feels like a massive tell.
Oh, it is. It's a masterclass in time horizon arbitrage. The short-term pressure is measured in months, but the long-term bull cycle remains entirely unbroken because the biggest players on Earth are still buying.
Time horizon arbitrage. I love that term. Retail is trading the weekly PCE print, while sovereign banks are trading the decade-long macroeconomic cycle.
Exactly. Central banks treat retail volatility as a liquidity event. When momentum traders panic and dump their positions, it creates the necessary volume for these massive institutions to accumulate heavy blocks of physical metal at a discount without spiking the spot price.
So understanding that major institutions are playing a long-term game really changes how an individual investor should react to today's news. Which brings us to the strategic playbook. How do you, the listener, actually apply this to your own strategy?
Well, the morning reports translate this institutional behavior into very specific guidance. The core warning is clear. Do not treat yesterday's minor bounce as a confirmed bottom.
Right, don't chase the market.
Exactly. The analysts explicitly warn against buying the top on a green day until gold decisively breaks and holds structural support above that 4,200 resistance ceiling.
Because chasing momentum in a highly manipulated consolidation zone is how retail capital gets completely chopped up.
Yeah, you'll get wiped out.
So what's the actual strategy they recommend?
It's all about capital management. You don't buy all at once. The reports identify a key accumulation zone waiting below the current price, specifically in the 4,050 to 4,100 range.
Okay, so framing that 4,050 to 4,100 pocket as an accumulation zone completely changes the psychology of a drawdown. Instead of viewing a price drop as a catastrophic loss, you map it the same way the institutional algorithms do, as an entry target.
Yes, exactly. You deploy capital in fractions. As the asset drops into that lower boundary, you scale into your position systematically. Buy in fractions on the way down, sell in fractions on the way up.
It strips the emotion right out of it.
It does. By stepping into the trade incrementally, you mathematically mitigate the emotional impulse to panic sell if the price drops another $50. You are mirroring the accumulation behavior of the larger players.
So the secret to surviving a market like this isn't having a crystal ball to catch the exact bottom. It's having a discipline to chop your investments into smaller, manageable bites.
Exactly. This raises an important question about greed versus strategy. The investors who get wiped out right now are the ones who lack the patience to let the trends confirm themselves. They leverage up on a slight bounce, hit that 4,200 wall, and get liquidated.
And what about the mindset for someone who already bought at a high price?
The institutional guidance advises against capitulation. If you are already holding the asset, don't panic sell at the current lows.
Don't liquidate into the central bank's bid.
Right. Treat it as a long-term asset. Don't let a single green day make you think it will rise forever, and don't let a red day make you think the market is dying. You hold the asset with the same generational time horizon that the sovereign buyers are utilizing.
Wow. We have mapped out a massive amount of market architecture today. Let's briefly summarize the data before we wrap up.
Sounds good.
The precious metals complex is currently locked in a chokehold. On top, you have the Fed's hawkish interest rates and a mighty U.S. dollar actively suppressing momentum, trapping gold beneath a glass ceiling at 4,200.
While silver hangs precariously just above a critical 64.5 support floor, acting as a warning signal.
Right. The entire speculative market is sidelined, waiting for the PCE data, watching that 60-day diplomatic clock tick in Switzerland, knowing that any breakdown in talks could send oil and inflation spiking right back up.
But underneath all of that short-term noise lies the unshakable foundation of central bank accumulation.
Exactly. So for you listening, in an era of terrifying headlines and total information overload, your ultimate superpower is discipline. Step back from the panic. Map your capital allocation logically, utilize those strategic accumulation zones without greed, and align your time horizon with the entities who actually move the market.
And I want to leave everyone with one final lingering question to ponder long after this deep dive ends.
Straight for it.
We have mapped out exactly how strong the U.S. dollar is right now and the undeniable appeal of a guaranteed 4.5% yield on government debt. The short-term mechanics overwhelmingly reward holding cash.
So, why are almost half of the world's central banks planning to hoard more zero-yield gold over the next 12 months? What long-term global shift are the central banks quietly preparing for that the panicked short-term day traders are completely ignoring?
That is the ultimate macro puzzle to solve. Because when the world's largest financial institutions start heavily hedging against the very currency they rely on, they are signaling a massive shift on the horizon. Watch the data, watch the accumulation zones, and above all, watch what the quiet giants are doing. Don't forget to like, subscribe, and comment your thoughts below. Until next time, thanks for joining us on this deep dive.